Welcome, my name's Chris Urso. I have Chris Gorman here with me from URS Capital Partners. We're here to do our second quarter 2026 update. So as you may remember, if you've seen one of these before, we break it down into three parts, kind of talk a little bit about the markets, the acquisition side, capital markets, etc. Then we get into our full portfolio review in great detail. And then we'll close out with a little bit of looking forward and what we're looking to accomplish over the next quarter here at URS Capital. So, hey Chris, welcome.
Awesome. Excited to be back for another one. I had a hiatus last quarter.
Oh, that's right.
It's good to be back in the chair.
That's right. We had a baby at URS. So for those of you that aren't familiar with URS Capital Partners, we started the company back in 2008. Since then, we've gone on to do a little over $1 billion of transactions, both on the acquisition, development, and disposition side. We've acquired over 5,800 apartments, and we've now developed over 1,200 apartments. We've sold 24 properties to date and generated a 32% IRR, 2.04 multiple. Our most recent sale was actually earlier this year in March of 26.
Yep.
And that was Belmont Heights in the Charlotte submarket. So we currently manage about $233 million of private capital. We built our business with private, ultra high net worth investors, friends and family. We've been very fortunate to develop some very long-standing relationships with those partners. And we're excited to continue to build upon those relationships as we continue to grow at URS Capital. So at URS Capital Partners, we have a New York office, and we also are vertically integrated with our property management team. So on the investment side, we have about 8 team members in New York.
Yeah, yep.
8 in New York, and then on the property management side, which is URS Properties, we have about another 65 plus employees throughout the Southeast. Our COO sits in Charlotte along with some of our other senior team members. We don't do third-party management. We strictly manage the URS portfolio. We're very fortunate. We've got some great people throughout our regions, and it gives us the ability to be very, very hands-on owner-operators at the end of the day. Chris is heavily engaged in day-to-day. Tom, myself, work hand-in-hand with the regionals, with our COO. Mike works hand-in-hand with our regional maintenance teams on our renovation projects. So it gives us the ability to identify issues quickly, react quickly, but also capitalize on opportunities quickly as well. So when we take over assets, one of our greatest strengths is probably within the first 6 months, executing our kind of turnaround plans for those properties that we acquire, because we're talking to our teams on literally a daily basis to ensure that the plans are getting moved forward. So very fortunate on that front. Big shout out to our entire team at URS Properties that's on the front lines every day.
Okay, URS current markets. So as you can see on the slide, North Carolina, South Carolina, Tennessee, Georgia, Maine. We're pretty strict and selective in the markets that we target. We have a presence in each of these markets here. I think we'd be open to Florida. We'd be open to some Midwest markets where, Chris got his start back in the early 2010s or so. But for the most part, a lot of our efforts are really focused on these 5 core markets. We look for efficiencies. We look for opportunities where we can have some economies of scale. And we see that in each of these markets. So no real update quarter over quarter here. I think we're pounding a lot of pavement here and trying to find opportunities. And we're really happy with the markets that we're currently in.
So from an overall apartment market, I don't think too much has changed. There's been a little bit of bright spots on the occupancy side, as you can see here. This is a chart that we thought was really good and started to incorporate probably about 3 quarters back now and track it quarter over quarter. It gives you a snapshot of kind of the rent, from a regional basis throughout the Midwest, Northeast, South, and the West. So in terms of supply, I know Chris is going to touch on that in more detail, so I'm not going to spend too much time there, but we did see occupancy move up a little bit quarter over quarter. Again, this is on a macro level, but it also shows you the overall strength of the apartment market and multifamily and why it's probably one of the most durable out of all commercial real estate asset classes. Occupancy is maintained, between 94, 95, almost 96%. But Q2, we ticked up a little bit, 95.5%. Again, from a national macro level, that's what we're looking at here. So just the health and demand, the strength of demand, we all know that we've touched on several times. We're now 4 years from kind of the peak of the market in 2022, and supply has been very persistent since then, right? So we started to see a meaningful amount of new deliveries in 23 that continued through 24, 25. We're seeing the tail end of that supply being absorbed through the market as we speak. You know, we didn't expect it to get any easier in 26. I think that's, you know, I'm proud of that. It doesn't make it any easier to operate through every day, and our teams, how hard they're working to, you know, shore up our occupancies and pick up any sort of incremental rent growth. But we do feel like every quarter that goes by, we're getting closer to the other side of that supply dump, supply wave, supply cliff, whatever, you know, the hot button is of the week that everybody talks about. But we feel like, you know, we're inching our way out of that supply glut, I think is kind of my feeling overall.
Yeah. So going to the supply slide, next slide here. So yeah, I think to your point, I think there was a lot of focus on 2024 being peak supply, and everybody kind of thought or hoped, or many people did, that because 2024 was the peak, all right, 2 years later, you'd see a lot of increased demand, some rent growth, some occupancy increases in 2026, 2 years thereafter. I think what this chart shows from RealPage too is, yes, 2024 was peak, but 2025 is still very elevated when you look at 10-year averages. That 100,000 unit line right there in the middle, you know, 2025 was at or above, you know, the entire year. So I think in 2026, we're still seeing that overhang from not only 2024, but 2025 as well. The positive thing, you know, sound a little bit like a broken record, those who watch quarter over quarter, like you alluded to, is we are getting further and further from the peak. And although there's a slight uptick this quarter over last, I think the trend is still down, right? We do see the data turning. So second quarter deliveries were approximately 77,000 units, and demand is still strong. More than 187 units absorbed in the second quarter. And occupancy from a national standpoint, did actually improve in the second quarter to 95.5. So we've all learned recovery is not happening immediately, and it's not going to happen evenly across every market either.
That's a great point.
But you know, the imbalance is narrowing, and I think the operating environment slowly is moving in the right direction, which is important, and we're seeing that, you know, in our portfolio as well.
Yeah, I think for me, like, always looking at the base case is how are we stacking up to kind of pre-21, 22, you know, pre-COVID levels, which you're starting to see. Like, we're back in line with, I think, Q1 2020. We're just about there in terms of deliveries for this year. When you look at Q1 to Q2, we're probably even slightly below. Yeah, we are below Q2 2020 supply side.
Yeah.
So that to me is like, okay, we're getting back to pre-COVID levels. We all know that COVID, you know, run between late 2020 and, you know, end of 22 was something we'll likely not see again in our careers. I'm not going to say lifetime, who knows? But I think in our careers, so when trying to understand, like, where are we going? Are we getting back to an equilibrium? It's really looking at that time period of pre-COVID, you know, when interest rates were normal, they weren't zero. They weren't bouncing around 25, 50 bips every day. And that's really kind of reassuring to us in terms of our thesis of buying really good quality assets during this time of dislocation. And we started actively buying aggressively in 24, and you see the chart there, you know, that was kind of the peak of supply. So there was a lot of downward pressure on the market. Interest rates were running. And our thesis has and will continue to be for the foreseeable future to buy quality assets during this time and be patient, to let them, you know, mature over time. And we believe that the further you get away from that peak of 24, these numbers are going to start to look very much more in line with historical norms, and get back to a place where concessions begin to burn off and you get to normalized rent growth, call it 2, 3, 4, 5%, depending on your submarkets. So in terms of capital markets, again, a lot of volatility there, given what's going on in Iran. Even as of today, this chart is almost useless. Woke up, this is now Monday morning, August 3rd, which is crazy. Last night, President Trump announced kind of a rapid plan to cease fire and open up the strait, and we opened up to rates down anywhere from 5 to 10 plus bips across the 2, 5, 7, and 10-year treasuries. But you can see on this chart, it's been a very volatile interest rate environment, specifically from Q1 to Q2 when you're looking at the 5-year treasury, and these are just spot rates as of the close of the quarter, but 392 to 419, 10-year 430 to 442, 30-day SOFR, the short end of the rate curve, has remained relatively flat. The Fed has not moved rates as of yet. I don't pretend to call interest rates. We monitor them. We have very, very, very smart investors. We're very fortunate that we've got great investors with us that share their macro views with us, kind of keep us up to date on what they're seeing in the markets when it comes to interest rates. But this is a lot of the reason why, which we're going to get to in a little bit, the transaction market has really been relatively frozen as of late. So you have kind of still some operational pressures from the hangovers of supply. You have a significant amount of interest rate volatility. You have geopolitical risk out there with the war in Iran. But this all creates opportunity in the midst of chaos. And that's the only way that I could probably explain the acquisition market as of late, which we'll talk about shortly, is totally chaotic. But from an interest rate perspective, spreads are still fairly tight for good deals, 65% leverage in good markets. Without a buy down, you're probably in the 130s these days.
Yeah.
With a rate buy down, you're probably in the low ones over. So you can still fix out 5-year debt at, call it 520 to 550, depending on the asset. But from our shoes, we remain relatively conservative on the debt side. We tend to bring a lot of capital to our deals in the form of reserves and future improvements, renovations, etc. So when you look at our average loan to cost on our stabilized portfolio, we're at 66.1%. Recently acquired 67.6%. And our developments were even more conservative. We take a very long view on our developments, meaning we go into them with the intent to identify good locations, build kind of a bespoke product, and put a 10-year hat on it. So we're not looking to build a deal, fill it up, stuff it, and sell it. We're looking to build it, fill it with good tenants, refinance on stabilization, and own the asset. So we leave ourselves a lot of margin there for the long term. So overall, 66% on the existing assets and 57% on our new developments and lease-ups.
Yeah, I think the multifamily space thrives on stability in terms of underwriting, which we're going to get to. Like, these deals they're very thin, so 5 or 10 bit movement may not sound like a lot, but when your year one operating margin is that thin, it has a big effect, and then you see the acquisition side just stall. So I think high, low, medium, whatever the case may be, just some kind of consistency goes a long way for our space, and that is not what we've had the last 3 to 6 months.
No, and you see it. I mean, on the equity side, capital markets, we talk on the debt side because we mainly deal in private capital, but in talking to like a lot of our brokers, a lot of our industry peers that deal with institutional capital, a lot of that's been locked. They're kind of frozen because of the volatility in rates, because rent growth is not completely jumping off the page, because of supply that's still being absorbed that we touched on. But that leaves the room for groups like us that can be a little more entrepreneurial, a little bit more nimble, be patient, because we're not a massive fund that has to push capital out. We're seeing an opportunity to buy higher quality assets at a relatively attractive risk-adjusted return profile that we wouldn't normally have access to, right? So when we start to see a 10-year settle down for, I'm not even going to say quarter over quarter, for month over month, where it's not moving more than a couple of basis points in either way. Same goes for the 5-year, and maybe the Iran war, starts to have a clear path to an exit there. We feel like at that point, and rents start to grow gradually, institutional capital is going to come pouring in, and then we're going to get priced out of those deals most likely that that we wouldn't historically have been able to acquire because of those reasons. So for us, again, it's a way for us to, maybe it's not screaming distress that's in the market, but there's enough of a dislocation and a liquidity from an equity standpoint that's allowing us to go out and buy deals that 4 years ago we could never compete on because the returns were so compressed.
Right. Yeah.
That makes sense.
Well said. URS sourcing activity, Q2 versus Q1. Almost all stats are up here. On the acquisition side, I can tell you the team is grinding every single day. 70 deals brought in this quarter, 46 underwritten, and 10 offered on. So the deals offered, we're making a big push, a big initiative to. Guidance is great. It's where we're going to start anytime we get a deal in, but ultimately we're going to underwrite these deals to a place that we're comfortable performing, and whether we're 1% off or 10% off, we're making the push to still paper up an offer and submit and give brokers that feedback. We've seen over the years, time and time again, the first process we go through on a given deal is not the time we actually win the deal. Where we come in second, third, fourth, eighth place all the time, and it's a matter of still papering up an offer, submitting at a number where we know we can execute, and staying close to the process. Like we alluded to on the interest rate side and all the volatility in the markets right now, it's a challenging environment to get deals done, and it's not just challenging for us, it's challenging for every group. So, I feel really good when we get to a best and final, and even though we don't win the deal, we talk about it all the time where it's like, hey, we're not winning the deal today, but we might win this deal 6 months from now. So we stay close, we get updated financials, we keep our models really tight, and we stay prepared, if we do get the call.
I think that's the edge that we try to, be really disciplined about. We're not a huge institutional shop, right? It's, we have one analyst, we leverage AI, we have Chris, myself that are on the sourcing side, and between Chris and I, we make 5 phone calls in a day and just want to say hello to some of our broker friends in the community. We're going to lead those phone calls probably with 2 to 3 deals per phone call that we should take a look at.
Yeah.
And that's where it becomes a little chaotic and exhausting because there's so much out there that's floating around that is, hey, these guys want to sell, they want to sell, this is what they need. And then it's like, all right, great, we love the deal, we love the market, it's going to be a function of price at the end of the day. So you have to get the broker's educated feedback, and it takes time. And it also, you have to be disciplined about where to focus your energy, and obviously disciplined with your underwriting at the same time. So it is an exhausting effort, but I think our edge is the ability to be so obsessive about, pipelining everything, keeping it organized, getting those follow-ups done where other shops, typically of our size, if you go under contract on a deal or you win a deal, you're not looking at anything else in your pipeline for the next 3 to 4 months because you just simply don't have the resources. We really try to stay close to those deals that fit all of our requirements and that we offer on, especially in following up on that process. And it takes a lot of work.
Yeah, just to give a sense of the market, anecdotally, a couple conversations last week, but hearing from multiple brokers that around 50% of deals that actually go to contract are closing. So just to put it in perspective, So sometimes in our seat you can feel a little discouraged. You put so much work into a deal, you don't win it. But like we've said, only half of those are closing, at least within a reasonable time from the call date. So just kind of speaks to what's going on in the market and our strategy as we move through 2026. Okay, URS activity per market. Not too much new here on the market side for us. We're drumming up really strong activity in Charlotte, 13 deals originated, Charleston, Nashville, Atlanta. Those are kind of our leaders, and that goes back to what we were saying earlier. Those are our target markets. We have a presence already in each of those markets. We have teams on the ground. So a lot of our time, energy, effort, and resources are going into these growth markets that we want to continue to expand in. So not too much new here. The major takeaway is the 70 deals we brought in. So I'd expect quarter over quarter to see these same leaders from an individual MSA perspective popping up on this chart each quarter.
So now looking at kind of Q2 versus Q1 transaction volume broken down now into our markets, as Chris alluded to earlier, we saw a pretty meaningful drop in some of the markets, and it's a little bit skewed in others. But for me, it's like looking at some of the bigger markets is probably more interesting in terms of like total dollar volume. A market like Charlotte down from 450 to 250. Atlanta down, from 400 to 350. Still a good bit of activity, but what we're hearing from most of the brokers that we're talking to is it's a lot of hangover. Q1 was really driven by deals from Q4 of 2025. Like very little. I think one broker I spoke to last week said like something like, if you're not planning a 6-month sale horizon in today's world, you're nowhere near being realistic. Deals are not closing 30 and 30. We seem to be the only ones that hold ourselves to that standard still when we do win a deal, but everything is taking longer. It's much, much harder from a financing side, right? With the rate volatility, from raising equity, with the uncertainty. It's more challenging. The operations are more challenging to keep pieced together. Pricing conversations are the norm on deals. So I think for me, the big takeaways on this chart is where the volume kind of is happening, right? Still, even though sales dollars might be down, you're still seeing some pretty notable transactions. 10 in Charlotte, 10 in Atlanta, 13 in Nashville, 11 in Charleston, versus prior quarter. Savannah starting to get some movement, which had no activity. So you're starting to see some bright spots, but also I think these numbers are going to go down a lot when we look at the Q3 side, based on the feedback we're getting from the brokers that we're talking to on a regular basis.
Yeah, that's an interesting point, because I was going to say, what in the aggregate, that's what's interesting about the Q1 versus Q2 is number of sales up from 42 to 65. That's extremely significant. And then sale volume in these markets up from approximately 1.6 to 1.8. Both pretty meaningful moves, which is a good thing. But I agree with that last comment. I'm very interested to see how Q3 shakes out based on a lot of the conversations that we're having.
I'd be pretty surprised if the numbers aren't down across the board, and in almost every one of these markets. So it'll be interesting to see. But these are the things that we're tracking, and internally we're obviously looking more so at the individual sales behind each one of these numbers. That's much more relevant to us, because you can always have things that are skewed in terms of like dollar values. Charleston can get 1 or 2 really big trades, and then the other 8 or 9 deals is really where the market is. So we're more interested in the details behind these numbers, but it also shows you where capital is flowing, and I think that's very relevant for us as we're looking at kind of the recovery side from 27, 28, 29, 30 plus in deals that we're acquiring today. And you still are attracting meaningful liquidity in your major markets, Atlanta, Nashville, Charlotte, through this kind of reset. Kind of dovetailing to what we were talking about, like some of the detail behind the numbers per market is we then carve it up based on vintage, 70s, 80s, 90s, 2000s, 2010 and newer, to give us a sense of where the market is pricing on both a price per pound and price per square foot basis. So as you can see on this chart, just kind of looking at the 1970s average across all of our markets, $123,000 a unit plus or minus $137 a square foot. $145,000 a unit for 1980s vintage, $171 a foot. And then you see some of the 90s here. This is probably a function of we would then look deeper and say like, okay, 142 a unit, 120 a square foot. What's driving that? Were there some anomalies in some of those sales? Whether it was a distress situation, portfolio driven, smaller units, whatever the case may be. And the same goes with the 2000s. Yeah, 69,000 a unit is not normal for a 2000s vintage and newer asset. So there had to be a story behind that or a misprint somewhere that got carried through, which is most likely. I mean, with the amount of deals that we look at on a daily basis, I can tell you there's not a lot of 2000s and newer vintage assets at $70,000 a unit. No. It's more in line with, as you can see, the 200,000s, 180s, etc. 2010 vintage 228, 2020 and newer 205. So again, this is a function of like the chaos a little bit that's in the market.
Yeah.
With some of the pricing that's bouncing around all over the place. A lot of it's sub-market driven. Profile of the asset. You can have a 2000s built, elevator served property, 4-story mid-rise type deal, 4 or 5 split, something like that. Trade at a meaningfully higher number than a 2000s built, 3-story walk-up garden deal in not the best neighborhood. So just gives you an idea of some of the stuff that we track on a day-to-day, week-over-week, to just get a good understanding of where the market is. For us, it's more, again, like I said, the details behind these numbers on an individual transaction basis is what tells us a better story.
Yeah, just one of the really most interesting things about this chart to me was looking at Charleston. Like, you think about the size of the Charleston MSA, it's less than 1 million residents, somewhere around 900,000, and you got $400 million of sale volume across 11 deals. Compare that to an Atlanta, where 6-7 times the size from an MSA perspective, and yet less sales volume and less number of transactions.
Everybody loves Charleston.
Yeah, it's pretty eye-opening. It kind of makes sense why it's a difficult market to buy in, because it's very competitive, and some of the numbers support that. So that jumped out to me.
Yep, that's a great takeaway.